Hi everyone, welcome back to the channel. Today, I will be diving into the global crude oil market, where geopolitical tensions, central bank policy, and supply demand dynamics are all shaping price movements in important ways. Let's begin with geopolitics. Recent Ukrainian strikes on Russian refineries, Israel's action in Gaza, and ongoing Russia-Ukraine conflicts have all added a geopolitical premium to oil prices. However, these risks have not caused direct disruptions in supply. What we're seeing is mostly sentiments driven spot rather than actual shortage in the market. Turning to monetary policy, the Federal Reserve delivered a 25 basis point rate cut fully in line with expectations. But what catch investors off guard was Fed's statement. It was way somewhat unusual and left traders uncertain about the path forward. The US dollar weakened slightly, but the impact on oil prices has so far been limited. On the supply side, OPEC Plus confirmed that production will increase by 137,000 barrels per day in October. Yet the reality is that spare capacity within the group is very limited, as many members are already producing above their quotas. Meanwhile, the US output remains close to record high at 13.49 million barrels per day. In addition, the end of the summer season in the Middle East has reduced power generation demands for oil, adding even more supply into the global system. Demand indicators are weakening. US refineries are undergoing seasonal maintenance, which will last until late November, with utilization rates falling below 85%. In China, processing volumes have also declined within OECD countries. Demand in the second half of the year could even turn negative. This clearly shows that global consumption is entering one of its weakest periods of the year. Inventories continues to build. In July alone, global oil stocks rose by 26.5 million barrels. The latest EIA reported showed US crude inventories increasing by nearly 4 million barrels. Futures markets are now reflecting a deeper contango structures, which signals expectations of oversupply going forward. In terms of price actions, Brent crude is currently trading around $68.5 per barrel, up about 1.5%, but trading volumes remains moderate and open interest in shrinking, a sign that upside momentum is weak. Technically, Brent is fluctuating between $65 and $67 with very high heavy resistance around the $69 level. Looking ahead, geopolitical events will continue to influence short-term market sentiments. But from a medium to long-term perspective, rising non-OPEC supply and weaker seasonal demands pointed toward ongoing inventory builds and downward pressure on prices. For traders, this means as well on real strategy is still the most suitable approach, particularly when Brent pushes above the $68 to $69 range. Of course, risk remains. Any unexpected supply shocks such as Russian export restrictions can filter escalations in the Middle East or a sudden OPEC plus shift towards production cuts could quietly send prices higher. A more dovish Federal Reserves could also weaken the US dollar and offer temporary support for oil. In summary, oil prices remain catch between short-term geopolitical noise and longer-term bearish fundamentals. The bigger picture will point lower even if volatility stays elevated in the near term. Don't forget to like this video and subscribe to the channel for more updates on global markets.